All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. We are joined now by Kathryn Rooney Vera. She is the Chief Global Market Strategist at Bulltick Research. Kathryn, thanks for joining us. And I guess let's just kind of start with what you make of what we've seen in the market over the last couple of weeks, what the key factors are or have been driving this market. And as we head into the summer and a reopening, a period where we expect that case counts will go up, testing is increasing. Is that really the market's biggest potential slip up here? Would be a resurgence, I guess, of the virus, not just in a couple spots, but more broadly through the country.
I couldn't agree more with you, Miles. I think that is the biggest risk going into the summer or fall here. The market is clearly forward pricing a strong recovery, V-shaped recovery, something that's going to improve in the very near term, bolstered by, of course, massive government intervention and a Fed that has almost doubled the size of its balance sheet. So I would say that combination of variables is what has taken the S&P 500 up 30%, the NASDAQ year-to-date positive up 2%, and risk appetite surging despite the U.S. economy being in the throes of what I think is the best case scenario recession, and maybe even very close to a depression.
And I guess the question would be, if you're looking at this market skeptically, as I think many are there any bull cases right now, I guess, that you are actually sympathetic to and that you look at and you say, you know what, they might have a point there. I mean, you think about the way people talk about the profitability of the FANGs, the dominance in their various markets. I mean, it's very much backfitting what's happening to justify the rally we've seen. But does that kind of challenge start to make you say, you know what, maybe this time really is different in terms of which companies are part of the market and how the market behaves on that basis?
Yeah, I think the decoupling of the markets and the economy is something that one has to consider if the investor wants to follow the Fed, which has been historically over the past more than 1 decade been a winning strategy, and the Fed has never disappointed and has been a winning one. Liquidity has certainly trumped fundamentals. And so if the Fed continues to act in the way that surprises the market, as we know, they're now buying high yield fallen angel ETF, anything could happen at this point. My understanding was that they couldn't actually buy non-government backed securities as per the Federal Reserve Act, but there's ways to get around it. So this is a liquidity driven market. So if one thinks that this decoupling can continue, then you're bullish. I'm skeptical. I think that if you have over the past 2 months, you've seen the fiscal deficit, quadruple for fiscal year 2020, and you've seen the Fed almost double its balance sheet. Really, can we continue at that pace? So I think that you're more likely than not to see authorities kind of back off a little bit, see how the economy evolves, and keep some of its arsenal for the potential risk of a second bout or a mutated virus causing the economy to shutter again in the fall.
So as you've shaped out the picture here, even with the word depression, but then also saying that the Fed has been a good trade to follow. Right. Is there a middle ground where you can look at any sectors? I know you've written you like tech and you like healthcare, but do you like them here? When we're right now, because we get that, when we're on the other side of this, sure, these big tech names are going to be okay, but is it okay to step in right now if you've been nervous and waiting?
That's right. That's exactly the point, Jen. And the fact is that we did like tech and we did like healthcare. And I do think that structurally those are the good sectors to be in, but not right now. I mean, with the S&P at 30% up, multiples at 22 times earnings, something has to give here. Either it's consumer confidence, skyrockets in a way we've never seen, or it's that PE multiples collapse driven by a collapse in prices. So something has to give. You can't have this insane divergence between the consumer in a consumer-driven economy and PE multiples surging through the roof. So something has to give. I do think that once you do get a drop off, if you get that downdraft that I'm expecting, then you would want to step into the broad market. I wouldn't be picking sectors right here. I think the market is prematurely discounting a V-shaped recovery. It's not going to be that. I think a W is even more possible than a simple V. So look, I think that you should be actually protecting now, look at over the next few months, look at buying tips. I've never heard anyone else say this, but hey, the combination that we see that is so potent right now, fiscal monetary stimulus and an event-driven shock, which is turning into a fundamental issue, will cause, I think, inflation to come to the fore over the course of the next 1 to 2 years. So look at tips, look at buying puts, look at building cash. If you bought tech and if you bought healthcare, at the bottom, 30% after the 30% rise, I think you should take profits.